We now come to section 7, project analysis and evaluation. Largely this section is a continuation of what we've been talking about, but we look at some real life scenarios. We look at how to compare different projects if the different projects do not have the same life. A simple scenario will be comparing a 2-year project with a 3-year project. Then we'll talk about the concept of capital rationing, where you have a fixed budget and you need to select projects given that budget. And then we'll talk about risk analysis, both standalone methods and market risk methods. First, we look at a scenario where we are comparing projects that have a different life, and we'll do this through a very simple example. Given a discount rate of 10%, which of the following mutually exclusive projects should be selected? One is project S, where the initial cash outflow is 100, then at the end of year 1 you get 60, end of year 2 you get 90. The other project is project L, where the initial investment is 140, and then you get 80 at the end of year 1, 70 at the end of year 2, and 60 at the end of year 3. Given a discount rate of 10%, and also assume that these projects can be replicated. It is a simplistic assumption, but what that means is that at the end of year 2, you can do project S again by again investing 100, and then you will get the same cash flow over the next 2 years. Similarly, project L can also be repeated. So before I go into solving this, I want you to think about it for a moment and tell me which project you will select. The naive answer here will be that you find the NPV of S, the NPV of L, and then pick L because L has the higher NPV. But that will not be correct, because notice that these two projects have a different life. We need to bring them on the same footing, and there are two ways of doing that. One is the LCM approach, the least common multiple. You might recall studying this in grade 6. What you do here is take both projects and put them on the same footing. If you take project S, which is this one, and replicate it twice, that means you do it once, then you do it again and again. So effectively then you have extended it to 6 years. And with L, you just do it once more, which will extend L to 6 years. Then you are comparing two 6-year projects, and you figure out which one has the higher NPV. The other method is called the equivalent annual annuity approach. Here you find the NPV of each project again, and then based on the NPV, you figure out what is the annuity. So what equal annual payments would give you that NPV, and you pick the project with the higher annuity number. Before we go to the next slide where the numbers are shown, I want you to try this on your own. So here is what you do with the LCM approach. This is project S. To put it over 6 years, we say, okay, minus 100, and then we get 60 and 90. But at the end of year 2, we again invest 100 to get 60 and 90, and so on. And again here we invest 100. So we look at the net cash flows, which would be minus 100, 60, minus 100 plus 90 would be minus 10. So you project all the cash flows and you figure out the NPV of this project, and what you should get is 72.59. You do the same with project L, which has been replicated once, and here you get 62.45. So based on this method, which project do you select? Obviously you select project S. The other is the equivalent annual annuity approach. Same projects. So what you do is the following. For each project, find the NPV. If you take project S and find the NPV what you will get is 28.93, and for project L you will get an NPV of 35.66. I'm assuming that you can do this. If not, then we have a larger problem. Then what is the annuity amount which is equivalent to this number? And again, this should be easy to do on a calculator. What we are saying is the following, that this is time 0, time 1, time 2. On your calculator, if you plug in a present value of 28.93, you plug in n is equal to 2, FV is equal to 0, interest rate is equal to 10%, and then you compute the payment. That payment is the annuity amount over here and here that is equivalent to this NPV, and the number you should get is 16.66. Use the same process over here. The numbers will obviously be different. N will now be 3. The PV will be this number. Interest rate will still be 10, and you compute the payment, and what you should then get is 14.34 or 33. So you pick the project with the higher equivalent annuity amount. Both methods can be used. The reason you need to know both is that on the exam you might be told that here are two unequal projects with these NPVs and the annuity amounts are this. Then rather than go through a calculation, if you are given the annuity amount, you just use that. For longer projects where it might be more tedious to compute the LCM and then all the cash flows, this method actually will probably be faster. Next is capital rationing. This is very straightforward, at least the way it is explained here in the curriculum. In the real world, capital rationing decisions can be much more complicated. The basic idea is that a company has a fixed capital budget and a set of projects where it needs to decide which projects to do. So take this scenario over here, 4 projects, a capital budget of 1,000. Of these 4 projects, which should be selected? Should you do project 1, outlay of 600, it has the highest NPV, so it looks good. And then should you do project 2? Between the others, you can just knock out 3 and 4 because they have negative NPVs. So clearly you just do 1 and 2. Do you say that you have a budget of 1,000, so you should also do 3? No, because it actually has a negative NPV. So you pick 1 and 2. Next scenario, 4 more projects, same budget. What do you do? Clearly project 5 makes sense. It gives you a big NPV. Project 6 makes sense, positive NPV, and you are still in budget. Then between 7 and 8, what do you do?
7.
You pick 7 because it has the higher NPV. And then this is slightly tricky. Think about what you'll do here. The projects are not divisible. You do project 9. Clearly that makes sense. It has a high NPV. Can you do project 10? You cannot because you blow your budget. So that is not possible. You still have the same budget constraint. Then between 11 and 12, the choice is interesting. If you do this project 200, it has a lower NPV compared to 12, but the IRR is higher, the profitability is higher. So should you do 11 or 12? The correct answer is you pick 12. Whenever there is a conflict, you go with the higher NPV. So greater wealth will be created by picking 12. So that's what you do. You pick project 9 and you pick project 12. Next topic, risk analysis using standalone methods. When we talk about standalone risk, we are talking about the risk associated with a particular project and in the context of that project. We are just concerned about the variability of that particular project. We are not concerned about other projects. We are not concerned about concepts like diversification and so on. And generally, standalone risk is measured by the dispersion of NPVs and IRRs, and we'll talk about what that means. The different methods of standalone analysis include the following. One is sensitivity analysis. Here we calculate the effect on the NPV of changes in one input variable at a time. The other approach is to do a scenario analysis where we create different scenarios and look at the impact on NPV. And then a more sophisticated method is the Monte Carlo simulation method, where we come up with a probability distribution of possible outcomes. Let's look at each of these methods, starting with sensitivity analysis. You are doing a project with this situation. You are selling widgets. Each widget has a price of 5. The expected annual sales number is this. You are given the unit cost, the investment amount, the project life, depreciation, expected salvage value, tax rate, and required rate of return. Now we'll skip the calculation because I'm sure you can do the calculation. But what we will say is the following. These numbers that were given are base values. Base values means these are the numbers that are most likely to happen. But are you sure that the unit price will be 5? You are not sure. So in addition to the base value, you take a pessimistic case or a low value case that maybe you will not be able to sell for 5. You might be able to sell for 450. Or you might take a higher range, which is 550. For all other inputs or variables, you also take a low value which is lower than the base and a high value which is higher than the base value. Then, given this information and given base values, can you come up with the NPV and IRR of this project? You can. And we'll assume that you know how to do this because we have done similar questions before. So what is the NPV? It is the investment amount, and where is this coming from? It is coming from right here. Then what is given over here? So this summation is your operating cash flows, and this is the terminal non-operating cash flow. So you come up with an NPV of 121,157 using the base case scenario. On the next slide, we will do the sensitivity analysis, where we will change one variable at a time and look at the impact on NPV. So let's do that over here. Starting with unit price. With unit price, what was the base case? Base case was a unit price of 5. Then if the unit price is not 5, if the unit price is 450, but all other inputs are the same, and this is sensitivity analysis, so we can only change one variable at a time, and that variable initially is the unit price. What happens to the NPV? It becomes 71,820. It makes sense that the NPV goes down. What if the unit price is 550? Then the NPV goes up. So what is the range? If only the unit price changes between the low value and the high value, the impact on NPV is quite substantial. It is 98,674, almost 100,000. Then what's happening in the second row? With the base case, this is the situation. This number 77,987 is if only the unit sales number is lower than expected, but all other variables are the same. And I hope you can now figure out what all these other numbers mean. Just looking at the information here, we can say that the NPV is sensitive to all these variables, but NPV is most sensitive to unit price, because a change in unit price has the biggest impact on NPV. The next analysis tool is scenario analysis, where rather than changing one variable at a time, we define 3 different scenarios. The most likely scenario is our base case. We define a pessimistic case where we change multiple variables. So we say that in a pessimistic scenario, what happens to unit price, what happens to sales, etc. And we define an optimistic scenario where everything is good. And then what will we do? We will come up with the NPV and IRR in all three scenarios. What is the riskiness of the project? The riskiness of the project is indicated by the dispersion of NPV. If you have a project where this dispersion is quite a lot, as we see over here, in a pessimistic scenario, you have a negative NPV. In an optimistic scenario, you have an NPV that is more than 2 times the base scenario. So this looks quite risky. And we are not going into more details here, but if there is a 33% chance of a pessimistic scenario, that means there's a 33% chance of a loss. On the other hand, if these three numbers were very close to each other, then we'd say that this project on a standalone basis is relatively low risk. The third method, which I think is less testable, is the simulation analysis or Monte Carlo. And in the real world context, though, it is very important. So what I'll do is explain how this works using example 8 in the curriculum. This person is doing a capital budgeting project, needs to make a decision as to whether to move forward with this project or not. And there are several input variables. There is a fixed capital investment. The project has a 5-year life. The fixed capital is depreciated over 5 years. And note now that when assumptions are made, the person also comes up with a probability distribution. So if this asset has a salvage value or expected value of 2000, can we be sure that at the end of 5 years the salvage value will indeed be this number? Or is it better to express this as a probability distribution? Answer is that since you are not sure, it makes sense to express this number as a probability distribution, saying that the expected value is 2000, but the actual value might be a normal distribution centered around 2000 and a standard deviation of, say, 500. Obviously, this input will depend on the person's knowledge of the project and knowledge of the economics of the situation. And then unit sales. The person is expecting sales of 2000, but can he be sure that the sales will always be 2000? No. So he models sales also as a normal distribution centered around 2000 and with a certain standard deviation. And so on. All these other inputs are also modeled as probabilities. Then this information feeds into a Monte Carlo simulation program. And this program then takes this input, takes 1,000, 1,000,000 iterations and generates a whole set of possible outcomes. And what it then does is expresses the outcome. Let's say the outcome is an NPV value. For every set of input variables, there will be an NPV. But given that the program is doing 1,000,000 iterations, it will really have a distribution. So NPV will have some mean value, it will have a standard deviation, it will have skewness, kurtosis, median. Now all this might look familiar from level 1 quant. So the NPV will have a distribution like this. If you have a distribution that is tight, low standard deviation, then you say the project is relatively low risk. If you have a distribution that is fat, in other words, high standard deviation, then you can say that this is a relatively risky project. The system will give you the distribution of NPV. It can also give you the distribution of IRRs. What about correlation? This is also important. What the system is telling you is the correlation between input variables and NPV over here. And what does that mean? The correlation between unit sales and NPV is 0.7. What does this mean? That there is a very high positive correlation between your sales number, how much you sell, and NPV. In other words, if you sell more, then you are going to have higher NPV. If you sell less, then you will have lower NPV. There is also a positive correlation between salvage value and NPV. The higher the salvage value, the higher the NPV. But this correlation is only 0.06. Notice how this is a useful management tool. Would you spend your management energy and bandwidth worrying about salvage value or worrying about selling more? Clearly, based on this analysis, it makes a lot more sense to put your energy where there is a high correlation between the input variable and the NPV. So this is also useful. On the exam, if you get a question on this, it will be about interpreting the numbers that are given to you. And I think more than anything else, it is your level 1 quant that will help you over here. Next we come to market risk methods for risk analysis. The distinction here is that when we talk about market risk, what we are saying is the following. An investor will be interested in a project, but the investor is concerned about the risk given his or her other investments also. So the investor isn't just concerned about the standalone risk of a given project. The investor is concerned about the overall risk of his portfolio and the impact that this project will have on his overall portfolio. When you are concerned about portfolio risk, then the appropriate risk measure to use is the beta and not standard deviation. Standard deviation is a measure of standalone risk. Beta is a measure of systematic risk. Now this is just touched upon briefly over here. This will be discussed in a lot more detail in equity and in portfolio management. Now the point here is that when you look at different projects, you need to use the capital asset pricing model to come up with the appropriate required rate of return. Projects with higher betas will have higher required rates of return. So let's take a simple scenario. For a given company or a given environment, the risk-free rate is 3%, market return is 8%, the company beta is 0.9, and the company is considering 3 projects. Project A with this beta, B with a beta of 0.9, C with a beta of 1.1. Are all 3 projects equally risky? No, clearly project C is more risky. So should all 3 projects have the same required rate of return? Obviously not. Project C should have the higher rate of return. So what should that higher rate of return be? It should be calculated based on CAPM, and I'm assuming that you know CAPM. CAPM formula is that the required rate of return is equal to the risk-free rate plus beta into the market risk premium. So what is that? The market risk premium is the market return minus the risk-free rate, which is 5%. This is the risk-free rate. At a company level, we use a beta of 0.9. So for your average company project, you use a discount rate of 7.5%. For a low-risk project, you can actually use a lower discount rate calculated using CAPM. And for the high-risk project, you use a rate which is higher than the company average. Fairly straightforward. Based on what we've just talked about, you should be able to do example 9, where you use CAPM to come up with the required rate of return. Then you have your various cash flows. So you compute the project's NPV. If the NPV is positive, you accept. And then you can compute the IRR also using a financial calculator. If the IRR is greater than this required rate of return that you calculate, then you accept the project. So try this and you should be able to solve this problem without any issues as long as you remember your level 1 material. And here is what you should get. The required rate of return should be 10.44. And the NPV given the information should be this. You can plug in the cash flows into a financial calculator and get an IRR of 14.24, which exceeds the required rate. So based on the IRR method, you also accept this project. Real options. Real options are capital budgeting options that allow managers to make decisions in the future that alter the value of capital budgeting investment decisions made today. This sounds like a mouthful, but we'll go through some examples which will make this clear. In some ways, they are similar to financial options because, as with financial options, real options are contingent on future events. If you think about a call option on a stock, the value of the call option is contingent on the value of the underlying stock. Similarly, real options are contingent on some underlying asset. The distinction is that with real assets, the underlying asset is a real asset as opposed to a financial asset. So there are several different types of real options, and we will talk about them at a high level. Then the curriculum has several good examples, and we will look at some of those examples. One option is a timing option, where if you are doing a project where you have the option to wait for, say, 6 months in order to gather more information and make a more informed decision as to whether or not to spend money on a large plant. Is that option to wait valuable? The answer is yes. So point is, you are here at point 0. This is time t. So if you have the option to wait till time t and then start your project over here, that is valuable because it gives you the option to collect information and decide whether or not to engage in this project. At times you might not have this option because if you wait, then the competitor might build the plant. But if you can do something, spend some money, buy a license or buy something, spending that money is like buying an option. And what is the benefit of that option? That you can now wait for 6 months. So this is called a timing option. Another is a sizing option. There are different types of sizing options. Growth and expansion option. So let's say you build a factory. When you build the factory, you don't know what the eventual demand will be like. So if you believe that it is possible that the demand will be very high, so high that your current factory will not be able to fulfill this demand, so you spend some money and buy the land right next to it, but don't build on it. The purchase of this land is like buying an option, where if the demand takes off, then you can exercise the option, and exercising the option would be building a factory on this adjacent land. So this is a growth and expansion option. Another related option which is used quite often is an abandonment option. Say you are in the distribution business. You get your input from a supplier and then you sell. And in your business, you need to sign 10-year contracts. So you are in a 10-year contract to buy a given commodity. And then it turns out after 2 years that the commodity price has changed so that it is no more feasible for you to stay in this line of work. If you are locked in with a 10-year contract, then you have a problem because you need to keep engaging in this not so profitable business. But if at the time of signing the contract you put in an abandonment option, where you might have had to pay something for that abandonment option, but that gives you the option of ending the contract if necessary and avoiding a loss-making scenario. That is another example of embedding an option into your real contract. You can also have flexibility options, which include price setting options, flexibility. So maybe your contract with your customer can be such where you have the flexibility to increase prices. Production flexibility, you might spend an extra amount of money on your plant so that you have the flexibility to build more kinds of products. You can set up arrangements with suppliers so that if you are not being supplied by one supplier, you can go to other suppliers. So in the way you make things, you can set things up so that you have multiple options. So note that the use of options over here is a lot like the use of options in regular English. And smart managers, when they do projects, they try to have options that allow them to make changes in the project at a later point in time once the project has already started. There are some projects which are entirely options unto themselves. For example, if you think about drilling for oil and gas, clearly there will be a certain amount of cost associated with drilling. Clearly there is a certain probability of finding oil and gas. Those who are familiar with the business know that when you drill for oil and gas, there is no guarantee that you will get oil and gas. There is a certain probability, and you need to spend a fair amount of money before you know what you are getting. So on what basis do you start drilling, given the cost and given that there is a finite probability of finding something? Clearly, the feasibility of drilling or not drilling depends on the market price of oil and gas, or market price of whatever it is that you are drilling for. So it will be feasible to drill if the market price is above a certain level. In that scenario, the whole project is an option. So when you have drilling rights, in a sense, buying those drilling rights is like buying an option, where the underlying is the market value of whatever you are drilling for, right? So if you think about it, the concept of real options shows up in many different scenarios. How do you evaluate and analyze real options? The curriculum doesn't get into too much detail, but gives you some common sense approaches. One is to use discounted cash flow analysis without considering options. And what this is saying is, if without considering an option, you do an NPV analysis of a project and the NPV is positive, then you just go for it. Because if you are doing a project where the NPV is positive and there are some options that are embedded in the project, the options can only add value. So if the NPV is positive, just go for it. What if you have a situation where the NPV without considering the option is negative? Then what you do is the following. You look at the NPV based on discounted cash flow alone. And let's say that this is some negative number. Okay, so say this is negative 50. But the project has some embedded options, and you can actually pay a certain amount of money for that embedded option. Say that you pay 5 for an embedded option, but the value of that option then is 70. By having that option, the NPV increases by 70. Then it makes sense to get this option, or it makes sense to spend money on the option, because by having this option, your project then becomes a positive NPV project. And we'll see an example of this shortly. Decision trees, the curriculum doesn't spend much time on this, but you can actually have the concept of decision trees. And since the curriculum doesn't spend much time on this, I'll not cover this particular concept. In finance textbooks that deal with real options, this can be covered in a fair amount of detail. But all this would ultimately be based on probabilities and time value of money. And finally, you can use option pricing models such as Black-Scholes or the binomial pricing model. And again, that's not covered over here. So now I want you to try this example. So here is what you should come up with. When you do consider the option, then the project NPV is 0.5 million. So note that you just need to understand the concept. The type of calculations that you will get will be fairly straightforward. Here is another scenario, which is an abandonment option. You are given some numbers, and then you are told that in 1 year, after realizing the first year cash flow, the company has the option to abandon the project and receive the salvage value of 150,000. Let us look at a few numbers in detail. This is your initial investment of 200,000. Then we are told that there are two scenarios. Either the project will give you 40,000 per year with a 0.5 probability, or the project will give you 80,000 per year with a 0.5 probability. When will you find out what's happening? You will find out at the end of year 1. But your decision to start needs to be at time 0, to start or not to start. So let's say you did not have this abandonment option. Then what is the NPV of the project? Then what you simply say is you have a minus 200,000, so that is your initial investment. If you get either 40 or 80, what is the expected value? 60. So you take 60 over 4 years and your NPV is negative. What this means is without the abandonment option, you will not do this project. But what if you do have the option to decide over here at the end of year 1 to abandon? Then what will you do? You can start the project, and at the end of year 1, if you get 80, that means that you continue. But if you get 40, then you can abandon the project and get your salvage value of 150. Do you think this option has some real value?
Yes.
It does. So how do you figure that out? You look at this situation over here. You say this is time 0, time 1. If you have a situation where you get 80 and keep going, then what is the NPV of that scenario? The NPV is 53,589. This would be the NPV of spending 200,000 and getting 80,000 over 4 years. But this has a probability of 0.5. What's the other scenario? The other scenario is that you get to this point and you get 40. This is the low revenue scenario. But clearly then you will stop the project over here. To stop the project, you will sell your asset for 150, the salvage value. So how much money will you collect over here? 190, discounted at 10, and the present value there is minus 27,273. What's the probability of this NPV? 0.5. So what is the NPV of the project considering the abandonment option? It is 0.5 into this number plus 0.5 into this number, which is this number. So now this becomes a positive NPV project. With that abandonment option, you will actually go forward. In other words, the abandonment option has actually raised the NPV by almost 23,000, which is substantial. All right. As you go through case studies at level 2, there will be some calculation based questions, but then there will also be some theoretical questions. This slide deals purely with possible theoretical questions. When we do capital budgeting, there are some classic mistakes that people make. What are those classical mistakes? One of them is not incorporating economic responses into investment analysis. So you are projecting cash flows based on your own perspective on what you are selling. What managers often get wrong is they do not think about what competitors will do, because obviously competitors will do something which might have a negative impact on future cash flow. So what is the point here? When you do cash flow analysis, think about what others will do and how that will impact your cash flow. Misusing capital budgeting templates. At large companies, there will be several capital budgeting templates. Make sure you use the right one. Pet projects. Senior management, the CEO, for example, might have a certain pet project which he really wants to do, but that project might not be in the best interest of shareholders. So doing those pet projects obviously is not the right thing. Basing investment decisions on accounting numbers. Investment decisions or capital budgeting decisions should be made based on cash flow. Incremental after-tax cash flow. Using IRR to make investment decisions. You might recall from level 1 corporate finance that when you have mutually exclusive projects, at times there might be a IRR NPV conflict. When there is a conflict, you should pick the higher NPV, not the higher IRR. Bad accounting for cash flows. Sometimes certain cash flows are missed. So make sure you don't do that. Overhead costs. At large companies, overhead costs can be substantial, so estimating them is difficult. Make sure that when you do your capital budgeting that you properly estimate all overhead costs. Not using appropriate risk-adjusted discount rates. Many companies have a certain weighted average cost of capital or a certain hurdle rate, and that hurdle rate is used indiscriminately across all sorts of projects. What you need to do is use a higher rate for riskier projects and a lower rate for less risky projects. Spending all of the investment budget just because it's available. So very often this happens in departments where people say that, look, if I don't spend my money this year, I won't get my budget next year. So they'll spend the money even on negative NPV projects. Failure to consider investment alternatives, that is self-evident. Handling sunk costs and opportunity costs incorrectly. So what's the correct thing to do? Sunk costs should be ignored. Opportunity costs should be considered.